Hello, welcome to Engineering My Money. I'm Roy Reyes. So today I want to talk about the housing market. I've seen a lot of talk in different outlets about a coming crash. So I do want to talk about that today with whatever data we have. No doubt, we're living in uncharted waters when it comes to the housing market mixed in with the coronavirus. So it's very difficult to predict. It was difficult in the past. Now it's even more, right? To predict what's going to happen in a year or 2 years from now. So I've seen, some gurus out there talking, but at the end of the day, they really don't have a clue on, what's going to happen as expected. So let's get started today. I want to start a little bit about an article about that was written about from the Federal Reserve Bank of St. Louis. Just a little bit about that article. I don't want to get too much into it, but that'll give us some material to talk about for my last part, which is a conclusion on what I think is going to happen based on at least on the information we have right now. So please stick to the end. Okay, so here's the article, and it's from the Federal Reserve Bank of St. Louis. Okay, and it starts saying that the housing prices have increased 4.4% in the last 12 months up to July. And what they're saying is typically the housing market signals that we are in a recession. We know we are in a recession, right? We saw the numbers. It was negative 30 GDP for the second quarter this year. So why are the housing prices increasing? Doesn't make sense. So the article says that part of that is because of the low interest rate, because typically low interest rate gives the ability to people to pay more for houses, and the houses go up. But then they also say that we know that there's a weak economic activity going on for such a long time. So the 10-year Treasury, is at 1.8, the lowest it's been in 1953. That's what the article says. And then my response to this is that yes, the interest rates are low, but we already had before the pandemic, there weren't enough houses. All right, there was a shortage. At least here in Florida, I tried with my wife to buy some houses on cash, under 200K houses. But we kept getting outbid by other cash offers, right? And so, yeah, there was a shortage, and we did see a lot, and they are still coming in, a lot of investors and people, trying to invest in the real estate market, which is a little worrisome. So in California, you also have the difficulty of building homes. Even remodeling homes is a pain there in California. So yes, the interest rates do have a factor. But that's one part of the puzzle. The other part is that we had less inventory. So of course, if you have less inventory of anything, it's going to go up. Then the article starts talking about some negative housing signals that are coming, and they list a few of these. Now, what they're saying in the first one is that the lien first mortgage delinquency for 90 days, it's up 4.4%. Now, this data really doesn't make much sense because remember we had the forbearance, and I'll show you a graph at the end about that. Forbearance, a lot of folks are getting into this forbearance, and a lot of them have already been there for more than 3 months. So they're part of this equation. So this data, it's hard to make any sense out of it because of the forbearance. It's something we haven't had before in the past, and we don't know how much of this 4.4% is related to that. Okay, then they continue saying that the banks set aside reserves for loan defaults, but they bucket this one in one loan defaults for different things. The banks have loans for cars, homes, and other things. So yeah, what it's saying is that the banks increased that amount because yes, they probably see uncertainty, and if I was a banker, I would do the same thing, right? People out of jobs, etc. Right? So yeah, that of course, because of the climate that we're living, right? Then it just makes sense. And then what they're saying is that the number three is that banks are making it harder to get a loan, right? And it's almost to the level, and they have a graph here of the 2008 difficulty for getting a loan. So it's almost right there. So yeah, that's a flag saying, hey, the banks are saying, no, wow, shoot, we don't want to give a loan to somebody, and then 2-3 months they're out of a job. So that's I think that's where that's coming from, and that just doesn't make sense. But at the end of the article, Another thing they said that the confidence, consumer confidence, is going down, and obviously, yeah, we're a little hesitant to spend on things that we did before because of the whole situation. But then, the article ends here saying this: the unprecedented nature of the current recession and associated economic policy responses make forecasting more difficult than usual. Okay, yes, of course. So basically, we have no idea what's going to happen, and it's just that the data is very confusing. The data is contradicting. The stock market is going up, and we have all these stimulus that are being dumped into the economy that that make things a little bit more nebulous. Okay, so remember we had this chart here of the forbearance. So it's saying that this year in March, we started getting, this amount of people, right, on the forbearance program for the different loan types. So here we have, up to, higher than 5 million, okay, around May timeframe. So what happens? So if we look at this chart, we can say, let's assume that most of these people are going to stay on the forbearance program for a year. Okay, and then that probably let's assume that at least half of these people are either going to find jobs and be able to pay, or they're just folks that are on the program that that actually have a job. So let's assume good assumption is maybe half of them for next year. So and when you're delinquent on your loan, it takes about six plus months to be able to actually get foreclosed on the bank. So what would that graph look if we did that? So so I took the liberty of taking the graph and like I said, slicing that to half the number. So and a year and a half in the future. So we're looking at around October 21, October next year, or November-ish is when we would start seeing some foreclosures in the market. Okay, so with the limited data that we have, we can say that foreclosures will probably start happening end of next year. Now, of course, that's if the government doesn't step in and do something else, like extend the forbearance or who knows what, or for some miracle the economy hopefully recovers, and we get out of this. But of course, if the unemployment now starts to turn to go down, and the economy starts to tank, then of course that time frame will change. And then I haven't even talked about the renters, so that's a whole other half of the story. So that will complicate things more. People having to leave their homes for rents. Now, in previous videos, I did talk about how the Fed, how the government wants to increase the inflation because of all the debt they have. So one way to service that is putting this hidden tax upon all of us, which is inflation. Okay, so if necessary, the government's going to go and throw money off of helicopters. That sounds a little crazy, but it's not, because they're actually trying to digitize, and I don't want to get into that more right now, but digitize more the dollar, making it easier to give out this money directly into bank accounts. I know they're doing that now, but they want to simplify the system to be able to do that quicker, and that's basically throwing money off of helicopters. So that way, you're able to increase the inflation. So what happens? Why am I saying all this? What happens is the whole. If you look at the whole scenario, what's happening? If an investor is out there, they're saying, "Wow, I have $1 billion, and I'm scared to put it into the stock market." And I want to put it in the bank. The treasuries are low. Where do I put my money to protect myself against inflation? Oh, a great one is real estate, right? Why? Because real estate, I can get good tax credits because depreciation. I can increase my rents in most places where they don't have rent control every year, making it a sweet deal for me to protect myself against inflation. So, what does that mean? That means that when the housing market comes down, they're going to be like, like these vultures on the roads, right? Where they're waiting for some car to run over some armadillo. And if you're in Florida, I see so many poor armadillos squished when I go ride bike. So that when they see the roadkill, they just dive in and get it. So I think when these houses come down, there are going to be a lot of these um, hedge funds. There's going to be, Wall Street, and people with billions are going to come in and try to scoop up a lot of the real estate to protect themselves against uncertainty and inflation. And the worry there is big time, because if you look at it, will be losing their homes, and they have to live somewhere, so they're going to go rent something, right? So now they go from homeowner to renter, and a company comes in and buys their home. There are even funds where you can put in like $100, right? And a lot of people put money in and they go out and buy real estate. Yeah, that's great for the person that's putting in the $100, but yeah, but it's the result of it is transferring wealth, right? And getting people out of home ownership, and and we have an election coming, so vote for the folks that don't put in all these regulations to build homes and remodel homes. It's just it's really bad for society. A healthy society needs people in owning their homes. Why? Because again, if you have inflation, right, you don't want to be a renter because you're always on the losing side. So think about that strongly. If you haven't thought about buying a house and you're lucky enough to have money or a job, seriously think about it. Think about it, because when this dip comes, that's the moment to buy the house. Or if you have an opportunity now to buy one, just go ahead and buy it. I would do that. That's my advice. I'm not an investor. I'm an engineer, so I'm just giving you the data. At the end of the day, you make the call. So yes, again, I think that next year, we'll see some houses on the market towards the end of the year, but that, I believe, at this point, that's going to be a short window because of all those investors trying to come in and scoop up, the houses. So plan for that, and be ready. Be ready, like the person is on the the runner that's waiting for the gun to go off. So be in that position, be ready, and plan things. So thanks for joining today, and hopefully you'll give the like button.